Howdy, Jacob here. Today we're looking at Western Gas Equity Partners. This will be the last company in our dividend yield screener. We will then be going on to what I call fundamentals, where we're looking for earnings per share growth next 5 years being profitable, forward PE positive, and then return on equity investment in assets over 15%. Basically, just looking for companies that can reinvest at very high rates of return. But let's review Western Gas Equity Partners. We see that they're in the oil, gas, and consumable fuels industry. 10.8 billion market cap on $17.5 billion enterprise value. Looks like they operate as a midstream energy company, primarily in the U.S. Revenue is up quite a bit, 1.1 billion to 3.2 billion in 10 years. Both margins are up quite a bit. Gross margin 52% to 69%. Operating margin 28% to 40%. Return on invested capital recently has been very high, likely just because price of oil is, or the price of their commodity that they do is, crude oil, natural gas is pretty high from inflation. But elsewise, history has shown pretty mediocre returns on invested, well, pretty subpar actually. Mid to low single digits is pretty subpar. But an 8% dividend yield is pretty substantial. Well beats the 4 that we're looking for. There was quite a bit of debt here, though. Let's look at that. $287 million on cash on hand, and then both short-term and long-term debt total just under $7 billion. Okay, that's quite a bit. That better be some cash flow here. And there's a little bit more recently, obviously, from what I said before. It's looking pretty positive, about 1.3 billion. But on a 5-year average basis, we're probably looking at just about a billion, probably even less because it has negative 600 million over here. So probably looking at maybe 700 million or so, 800 million on a 5-year average basis. And they're currently paying out 952 million. Even what they have right now, they're paying out well over 50%. We're probably looking at 60, 65, 70% payout ratio. That's more than I'd like, even though they really just they bought back a little bit of shares recently and their acquisitions are not too heavy. I do want them to start focusing on buying down debt since, right now, let's say it's a billion more recently. That's still 7 times that average to get to to pay off all their debt. But if you look previously or you look in prior years, it's not been as beneficial to them. And so I think that I definitely want the company to pay down some more of that debt just so that, when the debt comes due, you'll dwindle it down enough to where you can absolutely afford it. So I think I'm ready to make some assumptions here. Let's go with the revenue side. Pretty good growth so far. I just wonder, is it going to go down before coming back up? Even still, I'll probably say 3%, 13 on P, price free cash flow. And then margins have increased, but it's pretty cyclical. Maybe I'll say it's pretty close to its historical averages. Maybe let's look at the averages first, and then I might bump it to see what the impact is of debt. So let's say 7 billion, 2% increase on 7 billion would be about 140 million. And 140 million is about 10% of their recent earnings and free cash flow. And so let's bring this down to maybe 22% and 18%. They bought back shares recently, so I'll keep that in mind. Their debt, I'm going to cut in half, saying that they pay out about 500 million, which they can definitely afford, and then let's just cut it by a third. So let's cut it by a third, payout of about 650 million. That's a bit more reasonable of the average. And then again, maybe buy back shares when it gets stupid cheap and then pay down some of that debt so their ratio is a bit lower. And then we get to a price that needs to fall 39% to get a 15% return given these assumptions. Yeah, pretty interesting company. I think that even them cutting their dividend in half is still 4%. And so if you're looking for just that dividend yield, you're likely in a decent spot. you're really just going to want the company to see if they can start really focusing on debt pay down, which it looks like between 2020 and 2022, they were consistently, or they were net paying down debt rather than issuing it, which was great to see. And you just got to see, what they've been doing in their recent reports. See if they have any language about capital allocation for the future. You definitely want them to be buying back shares that are stupid cheap and then issuing dividends when they have nothing else to do with it. So hopefully I've enjoyed the video and has a great rest of the day. Thank you.